Welcome, focused learners, to The Explainer. If you've ever felt, completely overwhelmed by all that Wall Street jargon, the rolling ticker tapes, those overly complex financial charts, well, you are in exactly the right place. Today, we're going to just strip all of that away. We're breaking down the stock market using incredibly simple first principles derived directly from our source material. By the time we finish, you'll see that understanding the financial world doesn't require a finance degree at all. It really just requires the right perspective.
So let's start right at the very beginning and pose a super fundamental question directly to you. Forget the charts for a second, forget the confusing acronyms. What actually is a stock? If we want to truly understand the market, we have to anchor our narrative right here. We need to completely rethink what a business is at its most basic level. And to do that, we're going to use a surprisingly simple metaphor.
Okay, let's dive into this. I want you to completely forget about names and stock prices for just a second. Instead, think of a company not as some faceless corporate entity, but, well, simply as a basket. And this basket, it's filled with valuable stuff. Once you understand the simple basket concept, the entire rest of the stock market becomes embarrassingly simple to grasp. Everything we talk about today revolves around exactly what is inside this basket and who gets to hold it.
Now, what exactly is inside this basket? It's basically a mix of two things. First, you've got your tangible stuff, right? The things you can literally reach out and touch. We're talking trucks, computers, buildings, physical inventory. But then there's the intangible stuff. And honestly, this is where the real magic happens. Think about brand name and reputation. Take Apple, for example. Yes, they have warehouses full of physical iPhones, but their real value is an intangible brand name so powerful that people will gladly pay twice as much for their phone compared to anyone else's. That is what a company is, a basket full of valuable stuff, some you can see and some you can't.
Part 1, the funding dilemma. Borrowing versus owning.
So, now that we know what the basket is, who actually owns it? To picture this, imagine you're an ambitious carpenter and you're ready to start your own business. You've managed to save up 10 grand, which is fantastic. But it's not quite enough for a work truck and all the specialized tools you need. So you go to your buddy Jake and borrow another $10,000 at, let's say, a 5% interest rate. You buy the truck, the tools, and you get to work. Fast forward 1 year. You've worked incredibly hard, and your business is a massive success. You've made $50,000 in pure profit. Plus, you still have the truck and the tools. But now we've got a bit of a serious tension point. You have this giant pile of money, and you have to figure out exactly how to split it with your friend Jake. And this brilliantly illustrates the core difference between bonds and stocks. See, Jake lent you money. He didn't invest in you. In financial terms, Jake is a bondholder. He just gets his 10 grand back plus his 5% interest, and literally that is it. He gets paid first, he gets a fixed return, and he takes way lower risk. You, on the other hand, you are the stockholder. You have the ownership, you get paid last, meaning after Jake gets his cut, but you get to keep all the rest of that $50,000. You've got unlimited potential upside. But remember, if the business had completely failed and made zero profit, you'd have to sell everything just to pay Jake back, leaving you with absolutely nothing. Higher risk, higher reward. That rule never, ever changes.
Part 2, Scaling Up, the IPO and the Secondary Market.
All right, let's jump ahead 2 years. Your business is absolutely booming and you want to expand into new cities. But instead of taking on massive, crippling bank debt, you decide to sell little pieces of your company. Your friend Maria buys in, then Tom, then a few others. And that money, it goes directly into your business. This is step 1, an IPO, or initial public offering. But here's the major plot twist. Fast forward another year, and early investor Maria wants out. She sells your shares to someone completely new. That new person pays Maria directly. They do not pay you, and they do not pay the company. That right there is step 2, the secondary market. The absolutely crucial point to grasp here is this. It's exactly like a used car. Toyota gets paid exactly once, when the first owner buys the car brand new off the lot. After that, that car just gets passed around between different people on the used market, and Toyota never sees another dime of that money. Stocks work exactly the same way. What we call the stock market, Wall Street, or those apps on your phone like Robinhood or Fidelity, it's basically a giant used car lot. Trillions of dollars change hands every single year, but that money isn't actually going to the companies. It's just everyday people swapping ownership back and forth.
Part 3, the Tug of War, Value and Emotion.
Understanding that the stock market is literally just a secondary market brings us to this fascinating crossroads. It forces us to ask a highly logical question. If your money doesn't actually go to the company when you tap buy, why on earth would you want to own the stock at all? Well, there are two very specific ways an investor actually makes money from holding on to a piece of that basket we talked about earlier.
You profit in one of two ways. The first is price gains. This one's simple. You buy a stock at $50, the value goes up, and you sell it to someone else for $100. Boom, you just doubled your money. The second way is dividends. Some companies take their extra cash profits and deposit them straight into the owner's accounts, just for holding the stock. Companies like Coca-Cola do this all the time. Other companies, like Amazon, don't pay dividends at all. They just reinvest everything into growing the basket. So either way, you profit through price gains, cash payments, or a mix of both.
But look, no matter what kind of investor you are, everyone is obsessively watching the price. So what actually makes that stock price go up and down every day? It all boils down to one simple, undeniable force: supply and demand. That is it. If there are lots of buyers and not many sellers, the price goes up. Lots of sellers and not many buyers, the price goes down. A stock is ultimately worth whatever someone else is willing to pay for it at that exact second.
And what drives that supply and demand? It's just people betting on the future. Let's look at some real-world triggers. Apple announces a revolutionary new product, right? People think profits will soar, so they furiously start buying, and the price jumps. Conversely, a company reports terrible earnings. Investors think trouble is brewing, so they sell, and the price drops. Sometimes it's as crazy as Tesla tweeting about a new factory causing an instant 10% jump. Sometimes it's deeply logical, but honestly, often it is pure human emotion. News, rumors, and the broader economy can make millions of people panic or get super excited all at the exact same time. How people feel about the future moves the prices today.
Part 4. The boring but effective strategy. Actionable advice.
Now, what's really interesting is how you navigate this chaotic, emotional tug of war without, completely losing your shirt. The ultimate cheat code for the everyday investor is the index fund. The statistics show that most professionals cannot beat the market consistently, and frankly, neither will you. So instead of gambling on individual stocks, an index fund allows you to make one single purchase and instantly own tiny slices of hundreds of companies all at once. You get a little piece of Apple, Amazon, Google, Walmart, and hundreds more. If you buy an index fund tracking the S&P 500, you are essentially buying a piece of the entire U.S. economy.
Now, I have to be completely honest with you. This strategy is kind of boring. No one is going to be impressed if you brag about your index fund at a dinner party. But look at this number. Over the last century, the S&P 500 has averaged around a 10% return per year. Yes, some years it drops and everybody panics. Some years it shoots way up. But over decades, it just consistently marches upward. By simply putting money in regularly, refusing to panic when the market drops, and just waiting, this seemingly boring strategy builds immense wealth. So as we wrap up this explainer, I want to leave you with one final provocative thought. Knowing what you know now, knowing that a stock is literally just a piece of a basket and the daily price is basically just an emotional used car market, are you ready to stop gambling on individual stocks? Are you ready to step away from the chaos, embrace the boring but data-backed index fund, and let the historical growth of the entire economy quietly build your wealth? It requires patience for sure, but the math is absolutely on your side. Think about it.